Namyong Lee's commentary, long, we finally reached a dream, KOSPI 5000, where is Korea headed? KOSPI 5000 appears to be a historic milestone for Korea's capital markets, but an index is less a certificate of achievement than a statement of structure, and a structural statement only becomes meaningful when its causes and mechanisms are dissected. In particular, because the KOSPI is built on a market cap weighted structure, it is inevitable that rallies in a handful of ultra-large export champions pull up the entire index. When that structure is combined with a sharp rise in the KRW-USD exchange rate and a broad preference for holding dollars, earnings expectations for exporters can be overstated, or financial anxiety can be amplified in the opposite direction, causing abnormal swings. If KOSPI 5000 is to be anchored as a symbol of normal, sustainable growth, the number of companies that drove the index, their contribution, and the role of the exchange rate must be broken down into numbers so readers can grasp the reality at a glance. It is dangerous to interpret KOSPI 5000 as a number produced because the entire national economy improved evenly. An index is not an average, it is a weighted sum, and the weights come from corporate size. If a few large exporters rapidly reprice because dollar-denominated profits earned in global markets are translated into won, the index can surge regardless of the real economy's temperature. Conversely, if the exchange rate becomes unstable and fear of dollar liquidity intensifies, the public's lived experience can deteriorate even while the index holds up. When this gap is confronted honestly, KOSPI 5000 becomes not a celebration, but a test paper for national strategy. The starting point of relational analysis is to identify stakeholders first, then to structure how their relationships produce numbers through specific mechanisms. The stakeholders in this issue include large exporting conglomerates, small and mid-sized enterprises, household investors, foreign investors, financial institutions, pension funds such as the National Pension Service, and the government and central bank. Their relationships are bound together by interlocking links, profits and exchange rates, interest rates and trust, flows and expectations. If the force behind KOSPI 5000 is the growth of export firms, the exchange rate is both a magnifying glass that amplifies that growth and a loudspeaker that amplifies fear. For that reason, KOSPI analysis must not separate stock prices from exchange rates, but must explain them together as one system. The core mechanism behind export growth and the rise in the KOSPI must be examined. The diagnosis that the most important driver of KOSPI 5000 was the growth of overseas export companies strikes the heart of the matter. Exporters' sales and profits are heavily shaped by overseas demand, the price of the dollar, and global technology cycles. Industries with a high share of overseas revenue, such as semiconductors, automobiles, shipbuilding, defense and batteries, are more sensitive to global orders and dollar demand than to domestic conditions. When the earnings outlook for these firms is revised upward, markets move first by pulling future profits into today's prices. In the end, KOSPI 5000 became possible not because domestic consumption improved, but because profit expectations for companies that earn money in the world expanded. In this process, what matters is not the breadth of industry, but concentration. Because the KOSPI is market cap weighted, the larger the top companies' weights become, the more the index overrepresents the performance of a small number of firms. In general, the share of the top 10 KOSPI constituents can vary over time, but periods of sharply rising concentration recur. When the combined weight of the top 2 megacaps approaches or exceeds the 30% range, there are phases in which the KOSPI effectively behaves like an index of the top 2 stocks. In such phases, index gains can be powerful, yet market breadth tends to weaken, and the experience of small and mid-cap stocks drifts further away from the headline index. The core of export-driven growth is dollar cash flow. The more revenue a firm earns in dollars, the greater the possibility that won-denominated profits rise as dollar revenue increases. Here, The exchange rate acts as a critical amplifier. Even with the same dollar revenue, a higher KRW-USD rate increases one converted revenue, and depending on the cost structure, operating margins can appear to improve more sharply. This structure can change the quality of earnings, but it can also overstate the scale of expectations. Therefore, while acknowledging export growth as the central driver, the analysis must also present, side by side, how the exchange rate enlarges or distorts that growth. There is a method for reading the number of companies that lifted the KOSPI in numeric terms. The fastest way for readers to understand is to explain how many companies created the index's gain through the concept of contribution. In simplified terms, an index can be understood as a ratio between total market capitalization and the denominator implied by the index formula. For the index to rise substantially, total market cap must expand substantially, and the key is to identify where that market cap increase occurred. Total market cap growth is the sum of each constituent's market cap change, and each constituent's change is created by the combination of price movement and the number of shares available to trade. The conclusion is straightforward. KOSPI 5000 is determined less by how many stocks rose and more by how much the heaviest weight stocks rose. The most intuitive quantification is to illustrate top-end concentration. For example, if the top two constituents account for 30% of the index, a 20% rise in those two alone creates upward pressure equivalent to 6 percentage points in the index through simple arithmetic. If the remaining 98% of constituents average 0% during the same period, the index rises sharply, and readers experience the illusion that the whole market improved. Conversely, if those two fall 20%, the index can be shaken severely even if the rest of the market holds up. This simple arithmetic is the essence of the KOSPI structure, and it is a structure that must be acknowledged before calling KOSPI 5000 normal. The second quantification is the breadth of the rally. In a normal bull market, sector rotation appears, the number of advancing stocks increases, and the market's breadth widens. By contrast, a concentrated bull market is characterized by trading value clustering in a particular sector and a small number of names, limited participation in gains, and a failure of KOSDAQ and smaller caps to move together. If KOSPI 5000 was a concentrated rally centered on export mega caps, the index can be strong while the lived experience becomes weaker. This is the mechanism behind the paradox that the index is a festival, but the economy feels anxious. When this structure is decomposed through numbers and concepts, readers can accept it immediately. The exchange rate becomes the statistical channel that amplifies KOSPI 5000. The KRW-USD exchange rate is a hot issue internationally, and dollar preference has strengthened domestically as well. Explaining this only as psychology is irresponsible. It must be explained in numbers. The simplest formula through which the exchange rate amplifies exporters' earnings expectations is dollar revenue x exchange rate Saturn 1 revenue. For instance, suppose an exporter's annual dollar revenue is USD 100 billion. At 1/200, 1 per dollar, 1 revenue equals 120 trillion KRW, while at 1/500, 1 per dollar, it equals 150 trillion KRW, an increase of 30 trillion KRW. This does not mean profits automatically rise by the same amount, but depending on how costs are split between dollar-linked and one-linked components, there can be phases in which operating margins appear to improve. The second channel is valuation repricing. If a higher exchange rate lifts one-denominated profit expectations for exporters, valuation indicators such as the price-to-earnings ratio can be repriced quickly, accelerating index gains. When this occurs in companies with large market caps, the KOSPI level can change abruptly through valuation adjustments in only a few firms. At this point, readers must ask a critical question. Is the profit increase generated by a higher exchange rate a structural rise in competitiveness, or is it a short-term effect closer to translation gains? Without that distinction, KOSPI 5000 can become not a number of capability, but a number of exchange rate effects. The third channel is the financial anxiety premium. When the exchange rate jumps sharply, import prices rise, the pressure on living costs intensifies, and the burden on interest rate policy increases. At the same time, companies and financial institutions with foreign currency liabilities become exposed to FX losses and liquidity risk. In that environment, markets can attach a premium to large exporters while increasing discount rates on domestic demand firms and financials. In other words, the same exchange rate rise can generate outcomes that do not lift the whole market, but instead concentrate gains even more in the very group that lifts the index. This is why the exchange rate issue becomes both the engine and the risk of KOSPI 5000. Dollar crowding and the fear of an FX crisis must also be dissected through relational analysis. When the move to convert into dollars intensifies, it is not merely the psychology of individuals, it is a chain reaction inside a relationship network. Households buy dollars after seeing the exchange rate rise, and that demand feeds into growing foreign currency deposits and spot dollar demand at banks. Companies try to secure dollars in advance for import settlements and refinancing, increasing corporate dollar demand. Financial institutions require dollar liquidity to meet customer hedging demand and manage derivatives positions. Foreign investors sell equities and bonds and repatriate into dollars when risk aversion rises. When all these actions align in the same direction, the exchange rate becomes governed not by fundamentals, but by flows and fear. An FX crisis does not usually arrive simply because the exchange rate is high. Statistical warning lights appear in dollar liquidity squeezes, rollover pressure in short-term external debt, mismatches in financial institutions' FX positions, and vulnerability measures such as the ratio of short-term debt to FX reserves. The current account trend, the quality of exports, and the global interest rate environment also matter. In other words, the likelihood of an FX crisis must be judged not by a single number, but by a combination of indicators. From a relational perspective, the most important question is whether a feedback loop has formed in which one group's actions amplify another group's anxiety. Once that loop is formed, crisis probability can expand at the speed of sentiment. In this phase, the role of the government and central bank is not to fix the exchange rate, but to break the loop. When markets accelerate in fear, devices are needed to prevent dollar liquidity from seizing up. When markets grow complacent, rules are needed to restrain excessive leverage and speculation. If the expansion of overseas investment by ultra-large institutions such as pension funds structurally pressures the one, the pace and method must be designed so as not to collide with market stability. If that collision is neglected, an unusual combination can appear. The KOSPI rises because export megacaps are strong, while the exchange rate grows more unstable because of dollar crowding. In that moment, the public experiences the sentiment that the index is good, but the country feels at risk. There are criteria that distinguish a normal 5,000 from an abnormal 5,000. A normal 5,000 should show several statistical features. First, concentration among top constituents should ease, or at least rally breadth should expand. Second, profitability and employment indicators should improve not only for exporters, but also for small and mid-sized enterprises. Third, household real income and consumption indicators should not deteriorate. Fourth, the exchange rate should be managed stably, and dollar crowding should not harden into a permanent state of anxiety. If these conditions are met, KOSPI 5000 can be interpreted as structural national growth. An abnormal 5000 shows the opposite signals. Index gains concentrate in a small number of firms. Exchange rate rises over-amplify one earnings expectations for export megacaps. Foreign flows become unstable. Households flee into dollars, and domestic demand and SMEs remain stuck in a slump. Under this combination, even if the index level is high, the nation's risk premium can rise. In other words, KOSPI 5000 can become not a number to celebrate, but a number to warn about. The core truth readers must know is that the KOSPI is not the report card of the whole nation, but a result sheet that heavily reflects the report card of large export champions. If that fact is concealed, both policy and investment decisions are distorted. With the exchange rate issue added, the conclusion on KOSPI 5000 can be summarized in one sentence. Mega-cap exporters pushed the index upward, and the exchange rate amplified exporters' earnings expectations and lifted the index level further. Yet if dollar crowding and FX anxiety spread, the national trust premium can be damaged and volatility can rise. Because these opposing forces coexist, this is not the time for an index festival, but a time for system risk management. If the exchange rate stabilizes, dollar crowding eases, and the rally broadens, the path leads to normalization. If exchange rate instability persists, and the rally becomes even more concentrated, the path leads to abnormality. Korea's direction will be determined at this very fork in the road. Where is Korea headed now? There are three scenarios. The first scenario is managed stability. In this scenario, the exchange rate does not spike, volatility declines, and exporters' earnings remain driven not by translation effects, but by technology and productivity. KOSPI 5000 can then be maintained or rise gradually, with greater breadth across the market. Foreign investors reduce risk aversion, and households return from dollar crowding to diversified allocation. Policy restores trust through rules rather than discretionary intervention, and companies prove value through results and governance. This scenario is the most desirable route. The second scenario is a concentrated index under prolonged high exchange rates. In this scenario, the exchange rate remains elevated for an extended period, exporters alone remain strong, and domestic demand and SMEs remain relatively weak. The KOSPI can be supported by the performance of top exporters, but the public's lived experience can worsen. Pressure from living costs and interest rate burdens increases, and dollar crowding risks becoming a habit. Markets become more sensitive to volatility than to index levels, and even a small shake in policy trust can cause the exchange rate and capital flows to accelerate. This is a slow-moving but dangerous route. The third scenario is abrupt turbulence triggered by external shocks. If a global financial shock, a geopolitical rupture, or an escalation of trade conflict hits hard, dollar crowding and exchange rate spikes can occur simultaneously in a short period. Even if exporters hold up better than others, overall risk appetite can collapse and volatility can explode. If FX liquidity management is weak across companies and financial institutions, a phase can emerge in which both the real economy and finance are hit at once. The essence of crisis is not the exchange rate number itself, but the speed of dollar liquidity stress. The faster the stress, the more fear becomes self-fulfilling. To avoid this route, policy and market actors must begin now to break feedback loops in the relationship network and strengthen autonomous risk management. Citizens must be prepared for a second IMF-style crisis. Namyong Lee's commentary long has been presented. Thank you for watching.